My name is Stefan Königer. I'm managing partner of Koeniger Partner, a tax firm located in Stuttgart, Germany. Our tax firm specializes in both international and domestic tax planning for businesses, high net worth individuals, as well as family offices and trusts. Real estate investments by non-German domiciled persons have steadily risen within the last decade and got a significant push by the highly increasing rate of inflation. Therefore, we would like to draw your attention to how to structure or restructure your German real estate investments tax efficiently and how to avoid pitfalls. Part 2 of our series German Real Estate Investments, Tax Efficient Structures, deals with tax consequences investing in German real estate via a German corporation. So let's assume natural person NP, who is not domiciled in Germany, still intends to acquire an apartment building for a purchase price of 4 million euro in Berlin. In part 2 of our series, NP does not invest directly in German real estate, but via a German GmbH. Consequently, he either transfers financial means to German GmbH or grants a loan or a combination thereof. The German GmbH also faces incidental acquisition costs, notary, land register fees, as well as real estate transfer tax. Multiplying the purchase price of 4 million euro with the Berlin real estate transfer tax rate of 6% equals 240,000 euros as real estate transfer tax due. This tax is usually borne by the acquirer, meaning the GmbH. Depending on the situs of the real estate, the tax rate varies from 3.5% in Bavaria to 6.5% in North Rhine-Westphalia. What is also to be considered is that German GmbH is liable to German corporate income tax, plus a solidarity surcharge of 4.5%. The German corporate income tax is based on the surplus of the rental income minus depreciation, meaning 2% of the building's acquisition costs, interest charges, as well as costs which are related to the apartment building, for example, maintenance, administrative costs, and so on. If we assume that the GmbH profit equals 100,000 euros, based on a corporate income tax rate of 15% plus solidarity surcharge, this will result in an annual corporate income tax of approximately 15,800 euros. Including solidarity surcharge. Please note that the GmbH is also liable to trade tax at a rate of 14.35%. Nevertheless, a trade tax exemption applies if GmbH is economical owner of the acquired real estate for the full financial year and no other business activities are performed besides renting out real estate. In case GmbH sells the apartment building, the difference between the sales price and the tax base minus the sales costs is to be fully taxed as corporate income at a rate of 15% plus, of course, solidarity surcharge. In order to avoid trade tax on the sales profit, the transfer of economic ownership is to be executed at the end of the respective financial year. Furthermore, the taxation of the profit can be postponed if the sales price is reinvested in real estate. Distributions of profits from GmbH to NP resulted in 26.375 withholding tax, including solidarity surcharge. If a double tax treaty between NP's country of residence and Germany is in place, the withholding tax is usually reduced to 15%. If NP transfers his shares in GmbH as gift inter vivas or by way of death, German inheritance and gift tax will be triggered based on the tax value of the shares in GmbH. In general, the valuation of GmbH is based on the higher of its discounted cash flows or its net asset tax value. In practice, for a corporation holding real estate, the net asset tax value is usually of relevance. Consequently, the tax value of the apartment building ranges, as a rule of thumb, from 60% to 90% of its fair market value. Sometimes it is even lower. which offers tax planning opportunities for you. Please note that the inheritance and gift tax exemption of up to 100% applies if GmbH is classified as housing company. As already explained in our first video, children is granted a tax allowance of 400,000 euros, spouses 500,000 euros. The tax rate amounts to 19% in a hypothetical transfer of all shares of GmbH to NP's child. Please note that the tax rate can increase up to 30% in tax class 1. That means children, spouses. Furthermore, please take into consideration particularities may result if a double tax treaty is in place with NP's country of domicile. In a nutshell, investing in German real estate via a German corporation is, at least in many cases, a better option than direct investments as natural person due to the comparatively low current tax rate of approximately 16%. But you can even do better than that. In our next video, we will illustrate the German tax consequences in case of investing in German real estate via a German corporation which is owned by a foreign corporation. So stay tuned. If you would like to find out how to set up and structure your individual German real estate investment in a tax-efficient way, for example, optimization of depreciation, minimizing income tax, trade tax, and real estate transfer tax, protection from inheritance and gift tax exposure, including possible implications from the double tax treaty of your country of domicile, please contact us by phone or by email to make an appointment. We are looking forward to hearing from you. Yours, Stefan.